Welcome back. This is Corporate Radar, and the markets continue to hold in the green as we speak, marginally 30-40 points or thereabouts. But as promised, we have Neha Agrawal, the MD and Head of Equity Capital Market, JM Financial Institutional Securities, who joins us on the show. Hi, Neha. Good morning. Good to see you again. Well, let's address the point with regard to the fundraisers that we've seen this year. It's been very, very strong. My query to you is, do you expect this sort of a momentum to continue? If you could, break it up in terms of a number as well. And also the worry is, India is turning out to be the IPO factory. Are you worried about the quality of paper that's hitting the market?
Am I audible?
Yes.
Thank you for the question. I'm actually not worried. I'm very enthused with what's happening. You're actually seeing a confluence of entrepreneurial energy with investor appetite. It's really not an array of indiscriminate issuances which are happening. I think investors are evolving to proper filtration of data, strong management equivalence of corporate governance. They're believing in business models. And wherever we're seeing that there's even an iota of doubt on how the business will evolve, markets push back. So I think that filtration is becoming extremely key for the success of markets. Let me give you a few data stats, right? Calendar year 24, we saw close to 1.5 lakh crores of equity issuances on the main board. Continuing the trend, calendar year 25, with another 6 weeks to go, I think that we will probably beat the last year's high. As we speak, there are more than 200 documents filed with the regulator. If I really had to put some bit of probability, some bit of filtration, with many more transactions to file, I wouldn't be surprised if the next 12 months, we see 2.5 lakh to 3 lakh crores of equity raise with a lot of filtrations in the way the investors are valuing it. So I think it's a great time for Indian primary markets.
This is a spirited defense, Neha. Not that it needed to be defended, but point well taken. Morning, Prashant here. I spoke with Vishal yesterday, and he said, well, the pipeline is going to be a bumper into 26. Of course, all of it depends on markets and what secondary markets hold up like, and that no one knows. So if, the demand goes down, supply, I guess, will recalibrate accordingly. But, with NSE lined up and others lined up, I guess the numbers will be much larger. Which sectors, Neha, if you can give us a sense, are you seeing the maximum activity in? You're expected to see maximum activity in as we look into 26.
No, I think what is really different from raises, what we've seen the last 5-7 years, is this time it's all around. We're seeing sectors from new age tech, investors really giving credibility to large business models. We're seeing in renewable energy a lot of interest. We're seeing manufacturing take a large part of the mind share of the investors. If you see precision, R&D involvement in manufacturing, autocoms, I think we're a great bull over there as a house. We believe anything which involves the precision element into it, investors are lapping it up. They're expecting a large deluge of fundraise, in fact, in these three subsectors. I'm actually not a fan to see hot sectors, only some subsectors get capital. I think it's well bound this point of time. I think that's great for Indian markets.
So in a way, manufacturing, right, Neha? You think we'll see a much larger share of manufacturing businesses come into the market in 26?
In all our conversations, we're definitely seeing that mirror through primary markets. I think a lot of the growth capital is going to get infused via IPOs in probably the next 12 to 15 months to come. But I must caveat that this is to do a lot with, it's not commoditized manufacturing. It's, like I mentioned, it's a lot to do which is R&D backed, this technology. You're seeing the essence of precision come into manufacturing. And I think that itself will be spearheading a lot of our growth.
Neha, just one more question, just playing the devil's advocate here. I spoke with Sanjeev Prasad of Kotak yesterday on the sidelines of a forum, and he gave a statistic. He said over the last 5 years, there's about $100 billion worth of money which has been raised through IPOs. Only 15% of it, according to him, has gone into building assets, plant and machinery. Bulk of, everything else is basically exits. So it's a slightly broader question. It's about the so-called smart folk are selling, which is early investors, promoters, and it's, of course, en masse being bought by retail because foreigners aren't really there at this point. So just wanted you to address that. The number, that statistic was pretty stark.
No, I think the data point is correct, but I would put it in a very different perspective, right? So of the $100 billion, it's about $20 billion, which is primary infusion, and primary infusion has been to delever our balance sheets largely, or primary capex. But let's not forget, in the 80 billion, a large percentage of it is private equity monetizations. Now, how do the capital of PEs really come in, right? In the last 10 years, we've seen close to $400 billion of private equity raised for corporate India. They've incubated businesses. They've helped entrepreneurs grow. And after the company has reached a particular maturity in operational metric, they've gone and monetized their stake sale, which gives a huge vote of confidence to the boardrooms of those private equity investors sitting globally for them to infuse more money and incubate new businesses. So I actually think private equity monetizations is a great thing for Indian markets. Yeah. So yes, they've not gone to delever balance sheets, but they've gone to help businesses evolve.
Absolutely. And, that's an argument that we've heard from some of the larger private equity giants as well. Exactly that unless they monetize, how will they fund the next wave of ventures? But Neha, that's the morality argument that Prashant raised with you. I have the money question now, which is probably the most juicy part of this IPO debate, right? The pricing and the valuations that you folk are able to negotiate and get through, and kudos to you. I mean, the investment banking community, because you're able to secure whether they're exits, whether it's fresh money for the company. Now, that valuation, conversation, I just want to understand what's going on behind the scenes, especially when you're talking about new age businesses, these consumer tech, companies or platform companies. Is the pricing going higher and higher because there is a FOMO in the market? We don't have too much AI, we don't have deep tech, but we have a lot of consumer tech, and everybody wants to be on that train. Is that what is driving the pricing higher? Just walk us through the pricing mechanics.
Like I've always said this multiple times, IPO pricing in India, there's really no math or science to it, right? It's literally an art. It's a judgment. Investors are out there backing ideas, they're backing concepts, they're trusting the management team. I don't think now markets have matured. I don't hear investors telling me, let's look at 1 year forward revenues, look at guidances. I think they're graduating to quality. I think what's very, very important to the point of filtration, which I was telling you all earlier, is investors are backing business models. And to my mind, that is extremely refreshing when they're pricing transactions. And these aren't centered by 2 or 3 funds deciding valuation, right? You've gone out there, you've met more than 100 investors globally, domestically. And after consciously having those conversations, they're backing models. And that's how the IPO pricing, the judgment as to and if you see the last 5 to 6 months, the IPO pricing has been very accommodative. I think issuers have respected investor feedback, they've valued it, and thereby you see at least 20-25% return on listing. I think what's important right now, to my mind, is the sustenance of this listing price, which will be backed up only by good corporate earnings in the quarters to come.
Which just reminded me about Lenskart. I'm just checking the price on the screen right now, 420, because every time we have such high-profile issues coming up, that debate rages. So just to complete this point, Neha, for investors who need to understand how the new valuation parameters are working, so say a price to sales, is that here to stay? I mean, what is the learning curve that regular retail investors need to kind of, go up with? Because this is no longer about traditional price to book or traditional price to earnings, right?
No, I agree with you. I think there was inertia even with institutional investors probably a few years back because they were backing new business ideas. The point of validation wasn't proven in the markets. But off late, if you see with all the listed comps, the unit economics is working in their favor. They've delivered to their promises. And I think that itself is confidence building for retail. I'm a better fan of retail investors also plugging in some bit of the capital via mutual funds. Mutual funds, let them do their work. That's what they're meant to do. And those business models are being priced on revenue going forward. However, there is an implied multiple that they're working off on the PE or EV/EBITDA for those businesses going forward by the institutional investors. So I think, again, the point of validation is the listed peers have done extremely well, delivered what they had promised to the investors at large. I think that is giving the confidence to the new issuers when it comes to pricing discussions.
Well, it's a pleasure, Neha. We wish you all the best of luck. Thank you very much for joining us. Interesting chat here on CNBC TV 18 from the sidelines, the JM conference, which is underway. Thank you.